So today we want to look at capital market products. We want to invest, and there are so many ways you can invest. As we said last time, you can decide to uh, invest in equity. Equity is also known as common shares. They are also known as stock. Now, these shares, the advantage of investing in them is that they can grow in value. So if you bought them, for example, at 5 shillings, they grow in value up to even 30. For example, those people who bought Safaricom during IPO and that's initial public offer in 2008, Safaricom shares was going for 5 shillings. Right now, Safaricom shares is going for 29.45 Kenya shillings per share. So it grows in value. So for example, if you bought Safaricom in 2008 at 5 shillings, if you bought 1 million shares, right now, those 1 million shares will value at 29,450,000 from 5 million. That's increase in value of about 24 million in 16 years. Another advantage of investing in equity or shares is that you will be paid dividend every year. So apart from growth in value, there's also dividend that you get every year. For example, this year, if the person who invested 1 million shares in Safaricom, 2024, that person received 550,000 as dividend. And the person will receive dividend every year. So you get dividends in form of income. The shares also grow in value. So it's a double benefit if you invest in shares. Another avenue to invest is bonds. Now, bonds is different from shares. Shares is whereby you buy ownership. You buy ownership of a company. For example, in Kenya, we have about 60 listed companies. You can go to Nairobi Stock Exchange and buy any share. But bonds is like you are lending to those companies. So bonds come in two ways. There's corporate bonds for private sector, and there's government bonds. Government, you lend government. While for corporate, you lend companies, private companies. So we have different types of bonds. The first one that we have said is treasury bond. Treasury bond is where you lend money to the government and the government pay you an interest. So there are two types of bond. There's treasury bill also. Treasury bills is a short-term treasury bond. Treasury bill also mature 91 days. They have 91 days maturity. There are ones also matures at 182 days. So you can decide to go for 91 days. You are paid your interest plus money you lend to the government, or 192 days you are paid interest from plus the money that you lend. Then treasury bond itself goes for 1 year to 30 years. So you can decide to lend your money to government for 30 years or 20 years or 10 years, the way you want, or 5 years. So they come in those two. So government, if you want to invest in government, you can invest through treasury bills or treasury bonds. There's also called corporate bonds, as we have said. Corporate bonds, you lend to private sector, you lend to corporates, you lend to private companies. Like in Kenya, there are companies which have issued corporate bonds. We have Family Bank, we have Kenya Breweries, we have Kenya Mortgage Finance Company. Those three companies, they have a bond which pays an interest of 12.5% and above. The government rightly pays 13.5% interest rates. Then we have also what we call green bonds. Green bonds, you invest in projects which have environmental benefits. In Kenya, there is one company which have such bond, which is called Akon Holding Limited. They give an interest of 12.45%, so you can invest there. You can also invest in another type of bond, which is called M-Akiba. M-Akiba Bank bond is a government bond. whereby people can buy bonds through mobile phones. The minimum you can invest in such a bond is only 3,000, and it pays an interest of 10% per annum. So there are so many types of bonds that you can invest in Kenya, apart from shares. So we have shares and we have bonds. So we want to look at a case study. If you invest in a bond, and if you invest in shares, and if you invest in other avenues, for example, land or building, which one will give you more returns? As you can see, we'll start with a case study of Safaricom. If you invested your money in Safaricom in 2008, when each shares was going for 5 shillings, you say that that's 2 ways of growing your wealth. One, the value of Safaricom shares has grown from 5 to 29.45, meaning that right now, if the market value for your shares, if for example you invested 5 million shillings, that's 1 million ordinary shares of Safaricom. Right now they are valuing at 29,450. Now, the Safaricom has been paying dividends. Now, these dividends from 2008 to 2025, this person has received a dividend of equivalent to 11,500,000, meaning that if you add the value of those shares plus the dividend, this person has equivalent to 40,500,000. That's the value of Safaricom shares, the person who invested in 2008 to date. That means that he has increased. If he was not using those, for example, those dividends, the value has increased to 40. So that's the value plus the benefits, 40 million from 5 million. Let's look at a person who invested in government bonds. The person who invested in government, if you had 5 million, instead of buying Safaricom shares, there's a person who bought government bonds. Government bonds, you say that they pay an interest, compound interest. For example, during that time, it's paying an interest of 12.5%. If you took that bond during that time up to today, that person has generated a value of that bond have grown from 5 million to 33 million today. If you add that 5 million, because if you add, you subtract that 5 million, that person has made an equivalent of almost 28 million profit from 5 million. Though that value is still below the shares of Safaricom. Let's say that another person, the third person, took that person and took that money and bought land. That land in Kenya appreciates averagely at 8% per annum. So if that land appreciates for 8% per annum, at 5 million in 2008, that person have equivalent of 12 million in 2025. So that's a growth of 7 million. Assuming that that person used that money to build some rental houses, we are assuming maybe the land that it was maybe 50 by 100, he bought at 1 million and built it, maybe 10 rental rooms. At the market rate, we have found that that person by now could have got equivalent of 13 million if you exclude expenses. So we find that these rentals, we have not subtracted expenses, and we know there are always expenses associated with rental houses. So if you subtract 1 million, the least, still go back to the person who bought land and never used. So the person who bought land and never used grows from 5 million to the value of 12 million. The person who built rental houses using 5 million also have 12 million. But the person who bought bond have 33 million. The person who bought Safaricom shares have 40 million. So it's up to you. Can you check which investment avenue is viable? You see, there are alternatives. I've just given an example with Safaricom. There are so many shares that you can buy. But I gave Safaricom because I know most of people understand.